The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And Mark is here too.
Hey, Mike.
And welcome to About Money. It's Saturday, and we're going to talk about money today. You know, during the last 5 years, we lived through a pandemic that killed over 1 million Americans. Over 7 million people worldwide were killed during that pandemic. During the last 5 years, we saw a war that involved most of the countries of the developed world when Russia invaded the Ukraine. Not only did we see that war in the last 5 years, but Hamas on October 7th of 23 launched an attack on Israel, and Israel responded and ignited a Middle East fire. In the last 5 years, we saw a reversal of global trade and a push to onshore. Last 5 years, we've seen a bout of inflation where prices shot up over 9%, the most inflation we'd seen since the 1970s. Prices shot up like a rocket and came down like a feather. The last 5 years have been a very eventful time. So today, we thought we'd share. Each one of us has thought about 5 things we've learned during the last 5 years. And I thought we could just go around. We'll start with one from Al, one from Mark, one from Mike, and then we'll just kind of rotate around. But we'll talk about each one of those 5 things. So go ahead, Al.
Well, Mike, as you and I have talked many times, predictions are really difficult, especially.
They are, that's what.
And do you remember when we were going to have a recession? We were going to have a recession. We were going to have a recession. What happened?
99% of economists and CEOs and Wall Street gurus were convinced we were going to have a recession.
And we still haven't had a recession.
No recession.
We're seeing growth. We might even see more growth now that Trump is in with deregulation.
But you know, there were a lot of people. Money managers. You know, I spoke at a conference in California where a lot of billion-dollar managers were talking about that cut back their stock holdings 15 to 50% and invested in U.S. Treasuries, expecting a 5% return.
And how much cash was sitting on the side? I mean,
huge amount of cash.
In money markets accounts was 4 or 5 trillion, maybe even more than that.
Yeah.
Sitting in on the sidelines because everybody's so afraid that, we're going to have a recession and stocks are going to drop 25, 30.
Oh, I can remember. This was a slam dunk trade. So between 15 and 50% of your stocks, buy U.S. Treasuries at 5%. I mean, you get paid 5% for sitting on the side, and you know that the market's going to continue to go down, 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 and you're going to get 5%.
Yeah, and you and I sat here and doing the radio show in 2023, and everyone's talking about recession. There's going to be a recession the first quarter. No, by the second quarter. Definitely by the second quarter.
Yeah.
By the second quarter. And
Here we are.
Heading into 2025, and we still have not seen anything.
And those trades that they did, bonds prices went down, stock prices went up.
And they said
one of the worst trades in the last couple of years.
Yeah, and they said the yield on the 10-year was going to go 3.5.
Yeah.
3.5. You went to that conference, 3.5, 3.5, 3.5. You're the only one who said it was, 4.5, closer to 5.
I said 5.
And it was 4.4, 4.5, right in that
It got to
range.
4.8.
Yeah, it did. I know. But they were all wrong. And, these people, these prognosticators, they just sort of follow. One comes out with a recommendation, and they all just sort of follow the same path.
They do. Mm-hmm. And remember, the whole idea was that the yield curve was inverted.
Yeah.
And so inverted yield curves always were followed by recessions. And it reminded me of Samuelson's book when he said that the stock markets correctly predicted 9 of the last 5 recessions. I mean, we live in a world where things are dynamic. And everything was this.
At the time, like in 2022, when they were calling this, the unemployment rate was somewhere around 3.8%. Incomes were rising. We're starting to see inflation. They're starting to raise interest rates. And so, the yield curve was inverted. So, this is always precipitated by a recession. But how can you have a recession when the person's quitting their job because they can find a new job that's paying them more per hour or more per salary? It's really difficult.
It is.
It is challenging. And textbook finance has failed to predict the last 5 years. We've seen a lot of anomalies, a lot of items.
But I mean, we've never before had a time in which you had 4 million more jobs than you had workers to fill those. And instead of looking at that, I mean, to have a recession, you have people that are worried about losing their job. They don't buy clothes. They don't go to restaurants. They're hunkering down. That's not what we saw.
No.
We saw just the opposite.
We saw the inflation. We saw people had, and here's what I think why they predicted the recession is because of COVID. Everybody was flush with cash, and they bought everything they wanted to buy. And it's, nobody's going to be buying anything anymore because they bought all the stuff they needed because they were stuck at home. But they didn't realize that they were going to go spend on services. And the economy's transformed. That 67% of the economy now is a service economy as opposed to buying stuff.
Yep. So a very good thing that you learned one of the things that you learned over the last 5 years. I'll just leave one more thing. One of my favorite stories is about when the market crashed in 1987. And because I've been around a long time, I get all these old stories. There was a mutual fund wholesaler that came into the office and claimed $1 trillion had been wiped out of the economy. It so affected people. And this, remember, is in October. He said, you'll be able to walk into Nordstrom and hear a pin drop. Nobody's going to be there. I went home and I told my wife that. I said, we have to go to Nordstrom and see this. And we couldn't get into Nordstrom. There were so many people.
Plenty of pins.
Didn't somebody tell people that they'd lost $1 trillion? One of my favorite stories. Anyway, let's move on to Mark. You're first.
Yeah, the first was it does not matter if you're right if you're way too early.
So tell us more about that.
Yeah, I mean, with that comes with a conviction pick or an investment thesis or an idea where, like I said, a recession's coming. You will always be right if you say a recession is coming because it will come eventually.
That's how I predict the weather.
Exactly.
I say today.
It'll snow someday.
It is going to snow.
If you see Mike downtown, he's got his trench coat on, his hat, he's got a bathing suit on underneath.
No, I'm not that far out.
There you go. But again, with that, it becomes shares versus other complex decisions to invest or more large position taking. If you take that position too early, or you may be right about everything you're saying, or you may be completely on right, but if the market isn't timing it right, you may not make that money yet. So you have to wait it out.
Yeah, and Warren Buffett said you can buy a stock, and sometimes it takes a couple of years for the company to catch up. Mm-hmm. So it means sometimes you overpay for something, and you're right. Instead of going up, it goes down.
Absolutely.
And if you then panic and sell, you might miss the whole thing.
And I think that would be more painful, is selling and missing that right conviction than sticking through the tough downturn of it.
Yeah.
Absolutely. That's our job, right? That's what we do. We believe in
What did Peter Lynch say? If you're down 25%, you're not convinced you're a buy, you'll never have better than average returns, right?
That's right.
Correct.
So, I mean, it goes opposite of what most people feel. Mm-hmm. Most people feel you should buy a stock, and it should go up a quarter of a point or a half a point or a point every single day. I would love that stock.
Show me one.
The one that never goes down.
Yeah.
Actually, there was a person that had that.
What was it?
Madoff.
Yeah. Yeah. He had one bad quarter in 40 years. That's pretty good. We all know how that turned out. Yeah.
Absolutely.
So let me share my first one. We've talked a lot about this. And if the 5 years have taught us anything, as we come to the end of this year, staying fully invested achieves the highest returns in the longer run. Any number of studies have shown if you started with $10,000 and you missed the 10 best days, your total return, actually taking the figures from January of 99 through December 18, so you missed the pandemic, missing just the 10 best days out of 20 years means your return was just 2% versus 6%. Miss best 20 days, 1 day a year, and your return is minus 33%. Miss the best 30 days, it's minus is anyway, keeps going down. Keeps going down.
The counter argument to that, Mike, is always, well, what if you can miss the worst days too?
Oh, yeah.
Right?
For sure. You
But
do a lot better.
Yeah, but the best worst days and the best days are so closely tied together. Usually, it's impossible to break them apart.
That's what the sideline cash is for. Sideline cash is for when you have those bad days. Get that phone call and put it in.
But
But a lot of people don't, though, Mark. You know, they panic, right? They get frozen by indecision because it's going down. They panic. No, I don't want to go in and lose anymore.
yeah,
Well,
you have to guess right. By
that's-
just staying fully invested, you don't have to guess at all.
it's true.
You have to ride the down times and the good times. But statistically, it works better to be fully invested and stay fully invested.
We could have played Led Zeppelin's "Good Time, Bad Times" in between the commercials.
Anyway, we're coming to a commercial break, and we've only covered 3 of these. So don't go away. We have a lot more to get to.
About Money with your AFC team, Mike and Al, on AM 1300 The Answer. For more information, click on adamsfinancialconcepts.com.
Okay, we've been talking about the 5 things that we learned, each one of us, 5 things. We talked about 1 from Al, 1 from Mark, 1 from Mike, and now we're back to Al.
Oh, I got to come up with another one. Can I think about it?
Okay, or Mark.
I'm good. I'm joking with you, Mike.
Okay.
I think I learned is don't rely on bonds. They don't always move in.
Correct.
The 60-40 put, which I still think is a good portfolio, don't get me wrong. But to say that the bonds are a hedge against stocks, we saw that this last 5 years. They're not. Especially when in times of inflation, that bond portfolio is going to get crushed.
We've seen that any number of times. You know, we saw it in the 60s and 70s.
Mm-hmm.
We saw it during the 2008.
We have short-term memories, Mike. We forget these things. You know, we forget that these things are not counters to the equities market, which is brought up another question, Mike, as you and I have talked about. You know, the alternative market has just exploded, and we're getting pitched all the time with alternative investment to counterweight equities.
You know, I think it goes back to I think it was Winston Churchill that said it. What people usually do is usually wrong. I mean, when you get so excited about something doing well,
Yeah, I mean, you and I have discussed many times the private credit market, how it's exploded to trillions of dollars, from billions in the 2000s to trillions.
yeah,
And even Jamie Dimon came out and trashed it a couple of weeks ago in Barron's. I don't know if you saw the article. He said he's really worried about the private credit market. He said he's seen it explode. He said he thinks that there's a lot of unsavory players, and that so your alternatives can be somewhat suspect sometimes.
and I think the thing that you just said about Jamie Dimon saying when you begin to get suspect players into the market, in the beginning where you have really good players,
Yeah.
it's probably pretty solid.
Yeah, and I think there are. I think there's I sat in a CNB summit last January, I think, talking about private credit, and the guy mentioned 5. I didn't mention all the companies, but he mentioned 5 solid private credit that have been through several credit cycles, that know what they're doing, have done it in and out. But there's a lot of money flowing into that market, just flowing in like crazy because the returns are good.
And the one thing that happens as well is even the very best get hit. If you think back to the crisis of 2007, 2008, 2009, there were a lot of mortgages that were really good mortgages.
Yeah.
But when they started going bad, even the banks that had good mortgages, it took them down too. So it's a halo effect or a domino effect. Get some dominoes falling, it takes down a lot of others.
Yeah. Yeah.
You're talking about the contagion risk, and sometimes when you try to replace to diversify, you got to make sure you're assuming that risk and understanding that risk you're taking with a private credit, vice something like a treasury. Very different risks, very different players,
Yeah.
not the same.
Very true.
I mean, I don't think we'll see it till like 2028, because that's when a lot of those loans and a lot of the commercial real estate loans are resetting. So it could be smooth sailing 25, 26, 27, 28 might start seeing some of the water leaking out of the dam.
And it could happen before then too.
It could.
And
Yeah.
Al, part of your bonds discussion there goes with your first point, too, about not listening to the pundits of the recession. Because in a recession,
Yeah.
bonds are supposed to do very well.
Yeah.
And
Yeah.
when we raise interest rates, things like current bonds are supposed to do poorly, and things like mortgages are home values are supposed to be affected. And we also saw the opposite the last 5 years there.
It's a good point.
Double, triple mortgages and home values just
home values going up.
skyrocketing.
Right. Good point. Short supply.
And I don't know if that's actually happened in the past. Not in my lifetime.
I don't think so. I think you're right on that.
Like that was a real surprise.
Because in the 70s, Mike, home prices went down. Home prices were cheap.
Home prices were cheap.
Yeah.
Mortgage rates were high. I can remember getting a mortgage at 9.75%, and I sat across from the banker and said, this is really crazy. I said, that rates are way, way too high.
Yeah, you paid $20,000 for the home, right?
No, actually 40. No, you're right. It was $21,750.
Good guess on my part. That's funny. Yeah.
Oh, yeah. We pay more for a car now than we paid for a house in those days.
Pay more for a beam, yeah.
It's funny.
Okay, Mark.
Yeah. So point two, it's been a real big highlight, is that time horizon is more important than risk tolerance.
So tell us more.
Yeah, absolutely. So it goes into, when you talk about object-oriented planning and having different buckets of money for different goals, the overall risk tolerance of an individual, an investor, needs to be massaged and discussed to understand the time horizon so you can apply an appropriate risk tolerance to that bucket. Still maintaining the overall, but it's more important if you say, here's $10,000, I want to buy a house. Now in the 1960s, it's a lot lower risk. If you do it today, you're like, well, let's talk about that goal, right? Yeah. You need to grow this 10x in the next 3 years, we'll say. And there's a method to the madness to do it, but there's a bigger risk involved there, right? And most are not comfortable with that risk, so you have to talk about time horizon, apply that, more importantly, to the person.
And it really comes back to what we've gone through the last couple of years, because people with long-term time horizons, we've lost a couple of accounts for people that have walked away that had a long-term time horizon, but seeing their account down 20 or 30%, it just worked on them.
Absolutely.
And they had plenty of time to recover. Had they stuck around until this time, they would be seeing new highs in their account.
Exactly.
But 2 years ago, it was way down. And, we're also seeing something now with the election of Trump, that some people are really depressed.
It's true. And it's the focus point is higher lows and higher highs. That's the goal long term with all of these types of investments. And that's the test of time. Look at the chart. Higher lows, higher highs. You feel good.
And if you're objective, that makes sense.
And
but so much has become emotional.
It is. Well, and the emotion is played because of overall society has gotten to this 5-10 second soundbite that is now a fact, right? Or you can now have an opinion because you've seen a 5-10 second TikTok, and now you're an expert on this subject. It's challenging.
Well, that and then our thinking is all short term. We're told to only think the next quarter to next quarter, right? We're not told to think out 5-10 years on these things.
Well, think about money managers today. A lot of money managers are on a monthly basis. So their firms are looking and saying, if you made a profit during the month, we'll give you more money. And if you didn't make a profit, we'll take it away. I mean, that's not even quarter to quarter. That's month by month.
Very, very short term. And I do feel for investors and consumers who, I know I started in the industry professionally after the military in 2015, and inflation rates were zero, right? A CPI zero, basically. And that's how planning was kind of addressed. Hey, inflation will only be 1%, model it for maybe 3% to be aggressive. And then when you have a period like we've been through the last few years where you're getting that compounded 10, 7, it really looks at those people who've been along the way with the plan, and now were they aggressive enough to maintain that? Because if they were in that 60-40, that whole portfolio dragged with that inflation, and they're back to square one, planning, right, trying to grow.
So, yes.
Tough challenge. Huh?
Important point.
Thanks.
Let me move on to mine. Things that have never happened before happen all the time. Over the past 5 years, no one ever expected a war to break out with Russia invaded the Ukraine. No one would have expected that Hamas would launch the attack they did, or that Israel would respond in the way they did. If you would have told somebody in 2019 that we were going to experience this little piece of DNA, which is, I think, 23 pairs, is going to kill 1 million Americans and kill over 7 million people worldwide, if you would have told somebody in 2019, they would have called the mental hospital and said, You know, those.
And we're going to see a baseball player hit 51 home runs and 51 steals.
That's also. I mean,
Never seen that happen before, Mike.
True.
I know,
But they changed rules the year before.
Well,
No.
still, no one else has done it.
and it's as good as apple pie. Wait a minute, isn't he Japanese?
As good as California roll.
Yep. Things that have never happened before happen all the time, and we'll probably continue to see that happen. Anyway, your turn.
My turn again. It goes to back to Mark's last point about I see there'll always be failures. FTX, bank failures, the Silicon Valley Bank, and it goes to Mark's point because time horizon is more important. Why did the banks fail? Because they had long-term bonds. Their duration, which is where their bonds. But people don't care about the maturity of bond. They're looking for the duration. Duration just is a simple way, as a more fancy way of saying when do you need the money.
Yeah.
And they were long-term on more bonds because it made them a few more extra bucks. Had they been in short-term bonds, they would have had the liquidity to pay their things, and they went belly up. But that's a good thing. I think it's a good thing that these things happen because it shows you that you can't just always play loose with the rules. You have to stick to some sort of strict. The banks need to stick to some sort of strict retention of cash so they can stay afloat.
That's all about the regulations, right?
It is.
It's going to be interesting to see the next 4 years as they do away with a lot of regulations.
Well, it's kind of interesting you say that, Mike, because my other point about private credit is that the private credit market took off because of regulation, and if they deregulate, it'll allow banks to actually make some of these loans to small business again. I don't know how it's going to work. I don't know how, but they'll be able to make those loans again. So
Yeah.
that'll be interesting.
The banks will secure it.
I mean,
Yeah,
when-
of course. There'll be collateralized loan obligations in the CLOs. I mean, which is the same as the collateralized mortgage obligations in the 2008. So.
banks are funny. They say, we do not want to be regulated. Don't regulate us.
Oh yeah.
Until they begin to get a lot of failures, and
Yeah.
then we need government bailout.
Exactly. Yeah.
Don't go away. We'll be right back after this commercial break.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So let's go on. Mark.
All right. So the number 3 that I got was sticking to your conviction and ignoring the hype. And there's a real challenge in ignoring the hype these days. We already talked about the 5-10 second blast you get from information that's so spot on. And you've got this conviction of this 5-year plan or investment.
Yeah.
And you're like, wait, I could expedite that like 5 years. But it's all about sticking to your conviction and your beliefs in how you've appropriated that strategy. And do not pull the rug. Do not try to necessarily hopscotch or skip. Because if you do, if it works out, great. But most of the time, by the time you got the idea to try to skip that step, the step's already been put up as a wall and you're about to smash it.
And, there's the old saying that the stock market climbs a wall of worry.
Always.
Always. I mean, there's always going to be people that have negative things to say. Mm-hmm. Thinking back at the time frame between 2008 and 2019, and the number of people said the market was going to crash. Predictions that it was going to be so bad.
Yeah.
There would be blood running in the streets.
And I think you bought March 1st, 2020. It got real ugly and bloody for about 3 weeks. By April 15th, you were pretty much up.
Yeah. I mean,
And I know I have a saying, it takes billions of years to build a mountain, but water falls in a day.
yeah.
And that's just how Earth works, but it does apply.
It works in the market as well.
Yeah, it does.
It takes time, and people don't usually give it time. The perfect stock for individuals is a stock that if you buy it at $10 and you know that 40 years or 20 years from now it's going to be $1,000, if that stock goes from 10 to 150 the first day, and then to 400, and then to 800, by the end of the week, people will continue to buy that stock. Mm-hmm. And by the time you get to 1,000, you've got more shares. But if you have that $10 stock that sits at $10 for 20 years, and then on the last day it goes to 1,000, you're investing at $10 during that entire time instead of 800. Mm-hmm. You make a whole lot more money.
It's a lot better for the investor.
But most people would prefer to buy that stock and see it at 800 than at 10 for years.
Don't chase.
Don't.
I made that mistake once. Don't chase a stock.
I think everybody makes that mistake.
Yeah, I know. And you learn your lesson, right? You sit back and you go, dang, why did I keep chasing that at 6, 7, 8, 9, 10? All of a sudden I'm up to 8 and then back down to 2 and I'm stuck at $2.
That's a great point, too. Everyone makes mistakes. Everyone does. The people that continue to go are the ones that win. That's, again, billions of years.
You're not going to be right all the time, Mike.
No one is.
Even Mike's not right all the time.
Well,
Wait a minute.
Well,
I thought I was wrong once, but I thought I made a mistake once, but I was wrong. No, I mean, if there's the old saying in Wall Street that you have to be right 66% of the time. That means you have to be wrong 34%. Mm-hmm. You look at a baseball player, think of the guy that strikes out and goes out 70% of the time. He's wrong 70% of the time.
Yeah, but he gets in the Hall of Fame.
Mm-hmm.
If his lifetime batting average is failure 70% of the time, he's a Hall of Famer.
Unless he bets on it.
Yeah.
I have a baseball from a guy that lost 230 games, lost 230 games, but he's in the Hall of Fame because he won 314. Gaylord Perry. I mean, it goes with the territory. Sometimes you just have to admit, made a mistake, and you move on.
Yeah, and people think we have some sort of omniscient, or we know things that with the market, we have no idea. We stick to our convictions, like Mark said, but it's like from time to time, from day to day, from week to week, we don't know. Nobody knows, and people who tell you they do know, as my first thing is predictions don't work. They don't know.
I sometimes talk about the difference between novices and pros when you're talking about games, when you're talking about chess, slot machines, and poker. In chess, a novice never beats the expert. In slot machines, the pros don't do any better than the novices do. But in poker, sometimes a novice will beat a professional. But over the long term, the professional wins.
Mm-hmm. Absolutely.
And it's about probability. It's something that it's a matter of skill in some cases and a matter of luck. And in poker, like a 5-card draw game or a 5-card stud game where you deal 1 card down and 4 up, when you're sitting there and you see somebody getting 2 aces face up, that person has the best chance to win with only 3 cards. But it doesn't always happen once the rest of the deck is there. But the business we're in, it's all about betting on probabilities and trying to estimate what happened.
And risk management, not getting over your skis.
Yeah. So
what's your next one?
My next one is that analysts are usually followers, not leaders. They're usually late in their calls on when to buy and when to sell. A lot of times, by the time they get around to selling, the ship had already sailed a long time ago. And when to buy, they're emotional about it. Analysts are human beings, and analysts are emotional. Mm-hmm. And in the 90s, I sat in a few analyst meetings because I was doing a lot of biotechnology, and there were not very many people that were doing biotechnology. And I would go to biotech conferences, and I got to know a number of biotech analysts, and I would sit and listen to them talk to one another and come to the same kind of conclusions, and I figured nobody's really thinking this through all the way. Mm-hmm. It's like they were following the group think.
Mm-hmm. So even then there was a large consensus amongst the analyst community, you're saying?
Yeah.
I think that's bad. I think it's bad that everyone knows. It's like the tulips. You go back to the original bubble, right? And then you get all of them.
Every once in a while, I was able to take advantage of it with ProSite stock way back when, because they were table pounding buy. You have to buy this, and I was short. And I can remember one Friday afternoon when they had a conference call, and 5 analysts were on the call talking about how this was really a great buy, and I was short, and I was underwater, and I spent almost all day Saturday thinking, I'm probably wrong. What do I do? Do I sell? And do I walk away? By the time Monday opened, the stock had dropped 80% because it didn't work. But you know what? The strange thing is those analysts got credit because they got the news before the market opened that the product had failed, and they came out with a sell before the market opened, and they got credit for having predicted the drop in price.
But you got the money.
I got the money.
That's all that matters.
And all the people that listened to them lost a ton of money.
Because they didn't have time to get out.
Yeah.
Huh.
Anyway, that was my third. Al.
Number 5, a fourth.
Yeah.
Crypto is here to stay, Mike. Me and you have been trashing a little bit, but
I've
it
been
ain't going
trashing
anywhere.
it the whole time.
It ain't going anywhere. The Fed's
Agreed.
I think the Fed's going to come up with the coin. This is going to be, and they're saying more people are flowing into it. It's up to almost 100,000 a coin now.
Yeah.
Al, you brought up the FTX debacle
Yeah.
a couple of years back, and
Yeah.
for me, I've liked crypto. I've seen the use case for it. In 2016, I was in South Africa, Johannesburg, doing a consulting gig, and long story short, my flight, I was going to miss my flight. A gentleman gave me a ride to the airport, wanted to be a bus tour, so I offered to help him and his family pay for the bus tour. It was not a lot of U.S. dollars. And it took about a month to get the money to him to pay this, and my eyes were open because I could have sent him Bitcoin in 5 seconds.
Yeah.
And he would have had it. And I paid almost as much in fees to get the money to
Yep.
pay for his tuition.
Yep.
Than it cost him to go take the class.
No, it's not going anywhere. I mean, it might have its ups and downs, but I don't think it's an asset class that it's actually going anywhere.
Yeah. And I thought FTX might have that scam might have.
I think there'll be more.
caused it.
I think there'll be more scam companies out there.
There will always
I
be
do.
another
Yeah.
Enron or another Birdie Madoff. There's
Yeah.
always going to be those.
And they're going to be in the industries that are the least understood and that's going to be deregulated. Right, it's going to get more deregulation. That's why the price is skyrocketing, and more people are going to flow into it, knowing that there's a huge profit to make there, and I can essentially sometimes hide money there.
So my original IT guy told me that I should mint coins because he was minting coins. That's when Bitcoin was $250 a coin.
Ooh.
Yeah. He's long retired.
But back then, though, I didn't know the storages was sleazy, right? You didn't know where to store. If you bought it back in 2010, 2011, and you stored it, are those companies still around? Would you be able to find your coins in the lockers and everything? Was it? I don't know much. I don't know. I don't know much
You
about
store it
it.
on a hard drive, right? I was first introduced to Bitcoin in 2013, 2014, that
Yeah.
time frame, and it was used as like internet payments for ad builders on Facebook. So I ran them, and they're building Facebook ads, getting paid in Bitcoin. But I didn't really see. I was like, guys, that's fake money, funny money. It was not.
Yeah.
You know,
Yeah. Right.
I was wrong. I should have put my life savings in it right then and there.
Yeah. But who the heck knows? That's easier said than done, right?
Yeah.
And sadly, I didn't.
I mean, same time you could have put 10,000 into Tesla and you would have been worth $20-30 million, which would have been a lot safer. But right, I mean, that's when that stock went public.
Yeah.
I think Bitcoin's worth more than Tesla now.
That probably is, but I'm just saying, right? I mean, it's something tangible you actually can grab onto, right?
And that's the question of
What's-
crypto.
But it ain't going anywhere.
What's tangible?
We'll be back in a few minutes. We'll be back shortly with wrap this up.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
It's Mark's turn.
All right. This one might be a little more controversial, but the market is a marketplace and not necessarily a free market.
Oh,
No, why is that
Talk about
controversial?
that.
No,
Yeah.
no, I like that.
Yeah, I mean,
Absolutely.
again, it's still the best opportunity, the best way to grow wealth ever created, ever made, ever facilitated, and open to anyone who wants to take their shot at it, right? And anyone who wants to do this. So I do believe that. But when you're paying for data feeds, when you're paying for all these, and there's all these extra layers or the dark markets, dark pools that have been used. I mean, and those always existed. I knew those existed, but they were utilized for Warren Buffett per se to go and take a position in Apple and not spook the market or drive the price up insanely high. And one could actually make an argument that that shouldn't be the case either. But let's say assume that that's an okay thing because we don't want the FOMO, everyone dumping in, piling in. And if Warren Buffett has great capital, it's a good investment into a good company. But now that we've seen the utilization of the internalization, wholesalers, chopping orders from, like if you make an order from your phone on your Schwab app or on your Internet, wherever app, Robinhood, it goes and it's intercepted, it's chopped by a bunch of computers, and someone internalizes that. And it doesn't have necessarily price discovery at the best. I think Gary Gensler talked a lot about it during his term. It was like the price discovery is like 95% of retail orders or individual orders don't even hit the exchange. And
Before, in the slippage, right? The slippage, what's lost.
yeah, what's lost is price discovery, real price discovery, right? Or real free market that you could say. Which
It's like I was watching Casino last week. I've only seen the movie once. Like, I'm going to watch Casino, right? And they show this scene where the old mob bosses are in Kansas City talking about they're skimming off the top of the casinos tens of millions of dollars, and they're all really mad because they realize the guys that are in the accounting room are skimming off of them, and the skimmers are skimming off the skimmers, and they're like, so they want to go out and kill all these skimmers that are skimming off of them. Like, wait a second, no, you got, and the guy's like, no. You can't do that. You got to accept that you're skimming off the top. They're going to skim off the top. We can't just go kill everybody that's skimming a little bit for themselves. But that's Wall Street. That's what happens.
It is Wall
trade.
Street.
it is, yeah.
You know?
And, the people with the biggest computers have an advantage over that whole thing.
Yeah, and the people who have the better system. But you've read Flash Boys, Mark?
Yeah.
When they're just trying to get as close as they can and get their wires as close to the thing so they can get their trades in a split second faster than you or I.
Yeah, Mike and I were talking about it off air. Like the most valuable real estate in the world is not next to the exchange we see, Wall Street, right? It's in New Jersey, next to all the servers.
Yeah.
Because the speed of light is determining the winners and losers at this point in the game.
Where I grew up, Mike and Mark, Quincy, Mass. State Street Bank was there. So during 2001, because one of the guys that was head of security, there was a customer where I worked, and he was on call 24/7 after 9/11 because they were trying to bomb that. 60% of all NASDAQ transactions went through State Street Bank in that office and that cul-de-sac out there and off of right over the Neponset River in Quincy, Mass.
So, Spread took advantage of the arbitrage, was to take advantage of the arbitrage between Chicago and New York. And Spread wanted to build a fiber optics network line that was more direct than the average, because the average ran around along rail tracks and right-of-ways and so on. They cut 4 nanoseconds off the speed of transmission of data, and they were renting that for $20 million a month.
But that's the money that's involved when you can skim a penny off of billions of transactions. Skim half a quarter of a penny off of billions of transactions. 20 million. That's pocket change.
A pip.
Yeah.
So it bothers me that happens. It doesn't mean very much in terms of total price.
No.
Absolutely.
But in principle, it's irritating, right? In principle, it's just irritating.
Yeah.
Right?
I can anyway.
Yeah.
So let me move on. Everyone knows the way to make money is to buy low and sell high. Almost everyone knows that. But it's harder to execute than people believe. Most people get scared at the bottom and happy at the top.
It's a lot easier if it goes from 10 to 1,000 overnight.
But it's better to buy at the top and hold than to sell at the bottom.
Yeah.
Right. Most people will sell at the bottom, and in a good position. Like 2008 is a great example. I know one of my clients. They sold out in 2008 and never got back in. I said, well, if you put back in, you'd be freaking almost 7, 8, 9 times your money.
I have another one of my stories about. I was at a cocktail party and there was a teacher there, and she was talking. She never became a client, wasn't a client. But she said during the .com times, she was making a lot of money. And when it crashed, she lost 98% of her entire portfolio. She was convinced she was going to buy a CD and wait for it. And I sat and calculated afterward, a day or two later, and figured, she would break even by the time she was 712 years old.
With the CD, right? Not
With the CD, yeah.
But think of those .coms back then, right? Let's say eBay, Amazon dropped 92%, I think, its value.
Give a penny stock.
Right?
Apple was a penny
But if
stock.
you'd just stayed with that, Apple, right? Microsoft, if you stayed the course and left that, where would you be today?
Oh, yeah.
You'd be way back up and then some.
But there were some that just completely died.
Yeah, I know. And there's always, like we just said, there's always going to be, right? It's a healthy market is having, free market is having some failure.
Well, if you look at even the euphoria of the last 5 years, in 2020, 2021, that transition period with all the wild stock trading that was happening, there were some real winners in there. There were some real garbage companies that are bankrupt or have been facilitated by private credit to have a lifeline, and they should be gone. But there were actually some real winners.
Yeah, we worked.
Time.
That's when we should have shorted.
Yeah, we saw
our accounts up 77% in 21 and 20. Yeah,
Those were the good old days.
Those are
Actually-
those are fun years.
Actually, this year could be our second best year. But anyway, that's for another program.
I agree.
Okay, Al.
Number 5, don't underestimate Donald J. Trump.
Yeah.
You can't talk about the last 8 years, talking about markets and his effect on markets without talking about Trump. He's going to have an effect on markets. He had an effect in 2016. He's going to have an effect this year. He's already having an effect.
He has.
Whether we just talked about, does he keep Alina Khan? Mm-hmm. Right? She's the FTC chair. She's been stopping a lot of mergers and acquisitions from going on, going after Amazon and other companies. So
Will he keep her?
will he keep her? I don't know.
J.D. Vance
Likes her, yeah.
You're saying J.D. Vance liked her. I think she's done a really good job.
I like her.
I like
Wall
her
Street
too.
hates her.
Yeah, they hate her. Yeah, yeah.
That's a sign of someone doing a good job in that position.
I always am on the opposite side of Wall Street. I don't know why.
But I think that we don't know. We kind of know what his effect on cryptocurrency. But he wants to drill in the energy industry. I can think but we've produced more oil and everything in the last 4 years under Biden, which is ironic, right? People think of Biden as green energy, but look at the production of oil and natural gas. It's way up. And if we do that, that's going to depress the price. And I can't see oil executives wanting the price depressed.
Yeah. 1 minute. I want to get to
Go ahead. We're gonna
your
move
last
on.
one.
Yes.
Yeah. Calm and patience is the oil of compounding.
I think that's crucial.
Yeah, that's the most important.
Being calm, being objective, getting through, compounding.
Yep.
What's the old thing? If you have 1 penny and it doubles every day, how much do you have after 30 days?
A lot more pennies.
$10 million.
Eighth wonder of the world, right?
What does Warren Buffett say? It's not intellect, it's temperament.
Yep.
Yep. And being calm
Anyway,
and
that wraps us up for today. Have a great weekend. Have a great week.
Happy
5
Thank you,
things we learned over the last 5 years. I hope you benefited, and you have 5 things you really learned.
Have a good Thanksgiving week.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.